Good morning. It has just gone 8 a.m. across the Emirates, just past midnight in Washington, meaning President Trump's tariffs are set to take effect in just seconds from now. In other words, the world as we know it is about to change. And reminder, these are the reciprocal tariffs that the Trump administration announced last week. They are the higher tariff rates that are going to be applied on 60 specific trading partners, the ones that President Trump has dubbed the worst offenders. China will be the biggest casualty, set to see tariff rates go up to as high as 104%. The original rate was supposed to be 50%, but then, of course, earlier this week, they increased that rate to 104%. Other blocs, European Union set to see tariff rates of 20%, Vietnam 46%, India 27%, Japan 24%. These are the tariff rates that are going to be implemented in just moments from now. We had thought earlier in the week that maybe we were due for a reprieve or some form of a postponement, a delay. That did not happen. And as of now, the headline has just crossed. Trump's sweeping tariffs have taken effect, including that 104% levy on Chinese goods. So that has gone into effect. It has formally gone into effect now. As you can see, this is the reaction on markets. Huge day for markets here. Asia Pacific, broadly speaking, the index is down almost 2% in trading. Take a look at S&P futures. Once again, looking to open up in the red, down 1.8%. The USD taking a bit of a dip as well, down 0.3%. And this is the board as a whole. European markets looking to open deeply in the red today, down 3.7%. Again, as the world awaits to see how the European Union will retaliate, if at all, or try to negotiate with the Trump administration on lowering down that levy. So far, we have not heard a lot from them, in contrast to China, that have decided to confront the U.S. with their own version of reciprocal tariffs and other export restrictions as well. So it is a sea of red out there. But let me just point out to you the price action that we're witnessing specifically in U.S. Treasuries. Take a look at the price action this morning in fixed income, U.S. yields. This is not what you would expect to happen on a day where there is so much red and the handover from Asia has been so risk-off. 10-year yields in the U.S., 4.5%. We have moved 20 basis points in the last hour. We've moved 20 basis points higher. That sets the move for the week up at 50 basis points. The U.S. Treasury curve has been steepening. And what does this tell you? Well, capitulation of sorts, and the fact that there is a serious amount of liquidation going on in that space. And typically, as I said, you would expect a risk-off move to see money going into safe havens. U.S. Treasuries typically perceived to be a safe haven. That is not happening today. So a worrying development there. USD dipping somewhat, down 0.3%. So again, a continuation of that theme of moving away from U.S. exceptionalism trades, U.S. dollar coming under pressure this morning as well. And then Brent, keep a close eye on what's been happening with the energy complex. We are testing $60, down another 4%. And again, as we've been talking about, we've seen a move down of north of 15% over the last 3 trading sessions. As Morgan Stanley highlighted, this has only ever happened 24 times in history, 22 of which were accompanied by a recession. So keep a close eye on the energy complex. And then gold, perhaps the only safe haven really that's out there, is sitting at $3,000, marginally positive today, up 0.6%. But this market speaks of fear, and this is what we're getting. This is the reaction on the news that those reciprocal tariffs have now officially gone into effect. One other part of the market that we're watching very closely, and anyone who's been looking at fixed income has also been pointing this out, swap spreads. So this is the difference between where cash bonds are trading and interest rate derivatives are trading. As you can see, there's been a sharp tightening in the last couple of days, i.e., as investors shed their cash bond holdings, the yield on that is moving a lot higher than the yield of the equivalent interest rate swap. Again, that tells us that a lot of liquidation in cash space has been going on, and potentially on back of concerns about the fiscal outlook in the U.S. too, and what that could mean for the U.S. Treasury curve. So really big developments going on in fixed income and globally in financial assets. All right, for more on this top story, let's get out to Min Min Lo, who joins us from Hong Kong, our China correspondent. Min Min, 104% is the tariff rate that has now gone into effect on Chinese goods. Walk us through how China are reacting.
Yeah, I was just monitoring the Bloomberg terminal very closely for any news lines, but it seems like we still haven't heard anything fresh in the past few minutes from Chinese ministries in terms of fresh rhetoric or whether there will be fresh countermeasures aside from what they have announced already so far. But 104%, as you said, it's going to make U.S.-China trade really fall off a cliff. And we heard Trump saying earlier today that China is going to make a deal at some point with the U.S. He's waiting for that call from Beijing, meaning he's not going to make that call himself. Problem is, will President Xi be the first to make that call is the question. We know that the Chinese Commerce Ministry has said they're willing to fight to the end. At the same time, they are also saying they want dialogue. But the problem is, China is a country that really guards its pride. And the first two rounds of tariffs, the 10 plus 10%, we have seen China being very restrained in its measures. The third time that happened, China saw it as a slap in the face. They responded with reciprocal 34% tariffs. And it's not clear at this point whether China will want to be the first to reach out, given that President Xi in some ways is in a bind. If he doesn't reach out, he risks escalating things further. But if he does, he also risks losing face or appearing weak in front of his domestic audience. So this could be a long, prolonged standoff ahead.
Yeah, and yet the Chinese rhetoric has been one to confront the U.S. They don't seem to be looking for a negotiation right now. This morning, some comments coming through from the Chinese Premier Li Qiang saying that they do have the tools to fight back. They have ample room to fight these tariffs. Tell us more about the signaling that's coming through.
Yeah, this is clearly a move by Chinese policymakers to try to inject confidence into the capital markets and into the economy. Premier Li Qiang saying China still has ample tools to fully offset any negative shocks. He said that China's macroeconomic policies had already taken into account all the uncertainties so far. And suddenly we had seen China really pulling out all the stops. Yesterday, the Xinhua News app on my phone was just flashing headline after headline of all these state-owned companies carrying out share repurchases to try to put a floor on that market. And you saw today as well the stock market swinging between losses and gains, and especially onshore ending on the green today suddenly is because of that national team pouring in $12 billion of inflows into the ETFs yesterday to try to create that inflection point there. So the attention now from Chinese policymakers is really to ring fence the economy to protect it against these external shocks.
Yeah, and it's pretty remarkable this morning. The handover from most of these Asian Pacific indices is negative. Nikkei down 4%, Hang Seng down 1.5%. But as you say, onshore equity markets in China seem to be doing okay because of that support that has come through. Min, thank you so much for breaking it down for us. Let's continue the conversation now with Anastasia Amoroso, Chief Investment Strategist at iCapital. Well, you know, there were 7 minutes, I think, on Monday where for a moment we thought maybe there'd be some form of a delay in terms of the implementation. That hasn't happened. Yeah. How difficult is it to trade these markets when there's so much volatility and still so much policy uncertainty?
Well, it is extremely difficult, but I think we have to truly understand what is it the Trump administration is trying to achieve. And I think the conclusion that I came to, it's near-term pain is okay for long-term gain. And what the U.S. administration is really trying to do is restructure the U.S. economy and to make sure we rebalance our trade deficits and to make sure that we also rebalance global trade. And they're willing to take the short-term pain in order to do that. Now, when you start to put it in that context from an investor perspective, it means we should expect more short-term pain because, as you can see, these negotiations are not going to be easy. The tariffs are extremely sweeping. They're extremely steep. And different countries are going to take a different amount of time to potentially negotiate those away. But as investors, we have to assess what does this mean for the economy? What does this mean for the markets? And the read-throughs are not good.
Yeah, the read-throughs are not good short-term, as you say. I mean, as an investor, you can't really play the long game in this environment. You can't take the view that eventually in 5 years' time, this may lead to a rewiring of the whole world trading system. And also, Trump may not be in office in 5 years' time, right? So you have to focus on the short-term volatility.
You do, but I think, you know, different type of investor with different portfolios have to focus on different things. And what I would say is if you are an investor that is fully invested in equities or in risk assets, I think it is too late to de-risk your allocation. Maybe you could do that on the margin margin. You can, rotate into more defensive equities. You can add alternatives to the portfolio. But I will say at this point, we've priced in, at least in the U.S. equities, about a 70% probability of a U.S. recession. So maybe we price in that full probability. So you should hunker down and you should expect that choppiness, and that's how you deal with that. But I will say for other investors who have cash to deploy, I think they do have the luxury of thinking long term and thinking of what does this look like, not necessarily in 5 years, but let's say a year from now. And typically, when we see this spikes in bearish sentiment, for example, 60% of investors out there are bearish today. That number has probably gone up.
Yeah.
So which is, by the way, the most since the financial crisis. When you see these spikes in bearishness, these drawdowns in equity markets, typically over the period of the next 12 months, the markets on average
tends
are up.
to pay off to buy into
They're
this.
up, let's say, 23% or so. So that's the luxury that investors have if they have cash on the sidelines.
Yeah, no, definitely. But then equally, you don't want to be the first investor to catch a falling knife. Let me just ask you, what do you think is going on with U.S. Treasuries today? Why are we selling off so much? And why are we up 50 basis points in the last 24 hours?
I mean, it feels to me the spike that we've had is not only fundamentally driven. It seems to me it is driven by technical indicators, and there's conversations about the basis trade between the cash treasuries and the futures. And I think that probably has a lot to do with it. But I think the broader point is that this is a bit of a panic moment for the market, and it is reminiscent of March of 2020. And in that type of environment, no asset class is immune from these potential dislocations. So I think technicals are certainly at play. Fundamentally, I think investors might be questioning the long-term investment case for the United States. And I don't want to go too far with this idea, but a lot of countries around the world own U.S. Treasuries. And could they use that as a retaliation tool? I hope not.
Yes, certainly there's a lot of speculation in the market that might be happening. What about the fiscal outlook? The Treasury Secretary, Scott Bessent, he talks about wanting to bring the deficit down to 3%. But of course, they've got big plans. They want to implement further tax cuts, extend the tax cuts that were introduced in 2017, and even assuming all of these reciprocal tariffs stay exactly as they are, which, there's room for negotiation, that will raise $600 billion. That's not enough to cover the fiscal outlays. So do you think what is happening here is investors are pricing in this extra fiscal premium to the U.S. Treasury curve now?
Well, it's not enough, but it actually goes a long way. You're right that the estimates range somewhere between 400 to 700, or maybe on average 600 billion that could be raised if all these tariffs stay in place. And when you think about the Trump administration tax policy agenda, it is estimated to add $5.7 trillion to the budget deficit, but over the next decade. So if you think about that, that's about $570 billion, give or take, per year. So actually, tariffs could play a very significant role in offsetting that. Having said that, I don't think we're going to end up with the tariff rates as we have today. I think some of that will be softened and some of that will be rolled back. But let's say $200 or $300 billion gets raised from tariffs. That does actually begin to plug in the budget deficit hole that we have. So that's actually been one of the reasons why investors have been more constructive on treasuries. And that's why prior to today, we've seen a 41 basis point decline in treasury yield. So in a way, it is a smart way to try to appease the bond market. And if it ends up causing a recession, there's this extra gift of lower yields due to recession.
Yeah, well, assuming that playbook still takes place. I mean, today, obviously, things are changing. Quick final question. We're coming into earnings season. There's all that going on as well.
Yes.
I guess investors are not really going to be caring about what the Q1 earnings are. It's all going to be about the guidance, isn't it?
It's all about the guidance. And unfortunately, the guidance is not going to be great. First of all, some guidance may be outright suspended, because when you think about some of the retailers in the United States, how are they going to continue to import anything from China or Vietnam? I think is going to be really challenging. So I'm cautious about the guidance. I think what we're likely to hear from the corporates is that the second quarter is going to be about the realization of negative tariffs. It's going to be uncertainty, restructuring, and unfortunately, that's not a great backdrop for short-term investments. But again, if you think about it as a period of adjustment, I think long-term investors, they may not pick the bottom, but they may think about this dollar cost averaging approach.
Okay, that's a great way to end it. Thank you so much for helping us to make sense of everything that's happening today. Such a big markets day. Anastasia Amoroso, Chief Investment Strategist at iCapital. Meanwhile, an apparent rift between two key Trump advisors is escalating. Elon Musk has attacked White House trade counselor Peter Navarro on social media, calling him dumber than a sack of bricks and, quote, truly a moron. That was after Navarro took a shot at Musk by saying Tesla is not a car manufacturer, but a car assembler. Musk and Navarro are at odds over Trump's trade agenda, with Musk reportedly making a direct appeal to Trump to reverse the tariffs and Navarro advocating for aggressive trade measures. So just going to leave that one there. Okay, still ahead, we continue our coverage of U.S. tariffs with Luis Costa, the head of emerging market strategy at Citi. But first, Iran says it will start high-level talks with the U.S. in Oman this weekend. The details on that story next. This is Bloomberg. Welcome back to Horizon's Middle East and Africa. Checking the market reaction to Trump's tariffs. This is what we have on the boards right now. More and more red. S&P futures down almost 2% now. NASDAQ down 2% as well. This after moments ago, at the top of the hour, the reciprocal tariffs that Trump announced last week, i.e. those higher tariff rates on those 60 quote-unquote worst offenders, have gone into effect. China now sitting at a tariff rate of 104% on their goods that are imported into the U.S. Higher rates for the EU as well, 20%, other Southeast Asian countries. So this is the reaction. The handover from Asia Pacific with also quite negative, down 2.2%. Interestingly, though, we were speaking about this earlier, onshore Chinese equities are doing okay because it appears as though some stabilization has come through. But this is what equity futures are looking like right now. Take a look at Europe, down almost 4%. All right, let's switch over to the region. Iran says it will start high-level talks with the U.S. in Oman this weekend to discuss the standoff over Tehran's nuclear program. The meeting will be led by Iranian Foreign Minister Abbas Araghchi and Special U.S. Envoy Steve Witkoff. Joining us now is Bloomberg's managing editor for Middle East and North Africa, Onur. And Onur, what do we know about the talks that are going to take place this weekend? There was some discussion over whether it was direct or indirect, but I think it's safe to say they're direct because you've got, the U.S. envoy speaking to the Iranian foreign minister.
I think the confusion was solved mainly by the fact that Mr. Trump said they're going to be direct, and Araghchi, Iranian foreign minister, absolutely denied it. And it's whether or not Witkoff and Araghchi hold these negotiations while they're in the same room talking directly to each other is almost irrelevant to the big picture.
Yeah.
Because I think what is really important is what we should expect from these talks. And judging by what the U.S. State Department has made clear so far, we can safely assume that these are not going to be negotiations. The two men will come together and basically decide what is possible and what is not. And that means what they can possibly agree on in a realistic manner, in a way that kind of fits the time frame that was already dictated by Donald Trump. He gave 2 months to Iran to either reach a conclusion, a deal over the nuclear deal, or face the consequences.
What does the deal actually look like, Onur? And how is this potential new deal going to differ from what we had before, the JCPOA under the Biden administration? Of course, Trump pulled out of that deal.
So U.S. position, again, is quite clear. At least more clear than the Iranian position. The U.S. position is that, at least according to President Trump, no nuclear weapons for Iran. That's a basic formula, and that's easy to understand. So that's clear. On the other hand, on the Iranian side, that should not be a non-starter because Iran doesn't pursue a nuclear weapon according to its own rulers. But there is a gray area, and that's about how much uranium enrichment capacity Iran has right now and whether or not that has the potential to translate itself into an ability to produce bombs if Iran chooses to do that in the future. So that's where the negotiations will focus on. And what Iran is going to be seeking in return for any concessions is obviously going to be relief from economic sanctions imposed primarily by the United States.
Yeah, and of course monitoring is going to be key as well to make sure that they stick to their side of the equation. Do you think Iran wants a deal?
Well, it has a lot of reasons to want a deal. Everything from Iran's aging energy industry and infrastructure to its actual currency is in dire need of a relief from sanctions that would allow Iran to, first of all, A, make a lot more money than from its oil exports, and B, allow the country to open itself to foreign companies. Because without them, it's just impossible, it's inconceivable for any single country to deal with this massive set of challenges it is facing right now on its own without any foreign help.
Yeah. Okay, well, let's see what happens this weekend. Important discussions coming up in Oman. Onur Ant, Bloomberg's managing editor for Middle East and North Africa. Thank you. And we continue to watch the market reaction to Trump's tariffs that have gone into effect. The reciprocal tariffs half an hour ago. European markets down 4% now. Futures leaning to a very, very negative open. Asia Pacific Hanover 2.3%. And then U.S. equities once again back in the reds. Every single part of the market, every single sector in the S&P is now tracking negative for the year now. So there you have it. Another day of red looks like is coming up for us. We'll be back in a moment. Israel's Supreme Court has told Prime Minister Benjamin Netanyahu he cannot dismiss the head of the Shin Bet intelligence agency until further notice. Israel's cabinet voted unanimously several weeks ago to fire Ronen Bar. He and Netanyahu have quarreled over responsibility for the failure to prevent the October 7 attack by Hamas. The government has been given until April 20th to come up with what the court calls an agreed creative solution. Turkey is pushing ahead with plans to build military bases in Syria, a move that would raise tensions with Israel. This has now prompted President Trump to step in and say he'll mediate between the two Middle Eastern powers. In their meeting at the Oval Office, Trump asked Israeli Prime Minister Benjamin Netanyahu to be, quote, reasonable over any disputes with Turkey. Ankara is considering locations for new bases in Syria, where it already has thousands of troops. And the Kremlin says Russian and U.S. officials will meet on Thursday in Istanbul for a second round of talks aimed at restoring their diplomatic missions. The decision to launch embassy talks came after Russian Foreign Minister Sergei Lavrov met U.S. Secretary of State Marco Rubio last month in Saudi Arabia. President Trump has been moving to reset relations with Moscow, but his push for Ukraine ceasefire appears to have lost momentum. And back to equity futures. This is the indication for markets. It continues to get worse. The sell-off is accelerating. S&P futures down 2.4%, Nasdaq down 2.5%. European markets seen opening 4.3% weaker. So all of that is happening. Switching over, let's just take a look at the price action in treasuries. What a move this morning. Equity is pretty pronounced, but take a look at what's been happening with yields. 2-year, not a whole lot, but take a look at 10-year and 30-year yields. 30 years testing 5%. We are 22 basis points higher on the session. 10-year yields about 18 basis points higher in the session. By the way, all of this just happened in the last hour in the run-up to our show. So real capitulation, liquidation of longs going on in U.S. fixed income space, a pronounced steepening of the curve. The market in the front end is focusing on potential rate cuts, further rate cuts out of the Fed. Further out, there are serious concerns, and this is what we're seeing in terms of price action. But coming up, find out why Bloomberg Economics calls the OPEC Plus oil hike decision, quote, economically baffling. Ziad Dawood joins us on set next to discuss the price action in oil and more. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. In effect, the U.S. confirms President Trump's sweeping global tariffs are now in place, including 104% levies imposed on China.
They've ripped us off left and right. But now it's our turn to do the ripping.
Shock and awe. Investors welcome the tariffs with an accelerating sell-off. 30-year yields rocket higher, with Bank of America calling it a fire sale. And oil sinks to a fresh 4-year low as the intensifying global trade war threatens to batter energy demand. Brent extending its drop towards $60 a barrel. Well, it's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. I don't even know where to start with the price action this morning. Just half an hour ago, at the top of our show, we had those reciprocal tariffs get formally implemented. Tariffs as high as 104% now being applied to Chinese goods imported into the U.S., 20% on European Union goods. You have those higher rates on Vietnam, Cambodia, other Southeast Asian countries. There's 60 countries on that reciprocal tariff list, or what President Trump has called the worst offenders, and all of them one now have been implemented. This is really a day of change in terms of the global financial infrastructure, and markets are reacting to it. S&P futures down 2.6% now in trading, NASDAQ down 2.7%. The losses accelerating in the last half hour. European markets, take a look at how European futures are poised to open up today, down 4.4%. So again, the market perception is that Europe will be heavily hit from a growth perspective on the back of these tariffs as we await to see the European response. They're still being pretty quiet about what the response is going to be to these reciprocal tariffs. And in Asia Pacific, the handover for most of these countries is pretty negative, 2.4%. Interesting, we've been pointing this out on the show. Onshore Chinese equities, just onshore, are actually trading in the green because it appears as though some support has come through from some of the local participants. That is giving that market a bit of a boost. But relative to everything else in the region, it stands out because the handover from these Asian equities is also pretty negative as well. Just looking at where the Nikkei is right now, down 4.7%. Switch over, though, because that's not all. U.S. Treasuries, take a look at what has happened this morning. 10-year yields now up 16 basis points. At one point, we were about 25 basis points higher. We've come back a little bit, but still dramatic price action, liquidation, capitulation, whatever you want to call it. We are seeing massive selling of fixed income bond yields racing higher. 10-year yields 16 basis points higher. 30-year yields about 20 basis points higher as well, testing 5% now. The curve is steepening. And again, it could be on back of banks cleaning up their portfolios, liquidating positions because of liquidity calls, or it could be on concerns about fiscal premium in the U.S. So watch that space. USD slipping down 0.5%. U.S. exceptionalism, I could say, I think, is squarely over now as the dollar continues to drop. And then Brent also, you can see, sitting around $60, 4% weaker on the session. We're going to talk about that in a moment. Gold, the only relative safe place to be right now, up 0.9%, trading at around $3,000. Very quickly, let me just show you swap spreads. Why do I point this out? Digging into my fixed income past, but this is really a stark move. And what that's telling you is treasuries and the actual cash bonds are being sold at a much faster pace than swaps and interest rate swap and derivatives. And again, that tells you that this is specific to cash bonds and the bonds that banks, treasuries, that investors are holding in their portfolios. They're being shed at a faster rate than the duration position in interest rate swaps. That's why you're seeing this tightening. So something that people in the market have been paying close attention to. But let's go back to the price action in energy. Bloomberg Economics says the surprise OPEC Plus oil output hike, economically baffling and politically loaded. Saudi Arabia slashed its flagship oil price by $2.3 a barrel for May following the announcement. So Ziad Dawood is Bloomberg's chief emerging markets economist and joins us right now. What a day to have you on. We're saying that, we're sitting here talking oil is about to test $60 to the downside. And it wasn't just tariffs that got oil moving. It was that surprise announcement out of OPEC Plus to bringing extra barrels to the market. You don't think that was an economic decision, do you?
No, I don't find any of the arguments that says it was an economic decision quite convincing. It doesn't make sense when the market is moving the way you were mentioning is moving to add a supply shock to it. And these moves were not unanticipated. We all knew something big was going to happen on April 2nd. A big announcement was going to happen. It was already dubbed Liberation Day. And it was ought to add a supply shock to oil markets on top of it. And if you think in terms of profit maximization for OPEC Plus, yes, they may be producing more, and that may bring more revenue if prices stay where they are. But typically, prices move more than volumes. So whatever they gained on volumes, they lost on prices. And for them, it's a lost volume. If you think about the argument that they said, it's about punishing cheaters. Well, it makes sense to do this when prices are stable and high. It doesn't make sense to do that when your shock is drowning in a big demand shock that comes from sweeping tariffs from the U.S. on the whole world. So I don't find any of these arguments convincing that there was an economic motivation behind the move.
So what is the motivation then? Ziad, tell us. What do you think it is?
Well, if you look at the political sort of circumstances, there is a few things that may point that it was politically motivated rather than economically motivated. First, if you look at the two biggest sort of producers within OPEC Plus, Russia and Saudi Arabia, Russia is in the middle of negotiations for a Ukraine ceasefire, and lower oil prices play well in Washington. Saudi Arabia will receive Trump in his first presidential visit, and it's nice to provide a few lower oil prices ahead of the visit. Actually, hours before the OPEC Plus decision, Saudi Arabia and other Gulf states said that their bases and their airspace would not be used in an attack against Iran, and maybe that move was, to sweeten that announcement. So you have a bunch of sort of political announcements.
Okay, fine. I mean, I've heard that from other people as well, Ziad. But at the same time, they're also shooting themselves in the foot. Like, why would you accommodate so much to what Trump would like to see, which is lower oil prices at the pump, if it means that your own economy is going to pay the price? We know, because we talk about this all the time, Saudi Arabia have huge spending plans in the pipeline. As a consequence of lower oil prices, they will have to scale back. They're going to pay the price.
Let's talk numbers here.
Okay, let's talk numbers.
Let's talk numbers. So how costly was that move? Because bear in mind, there's also a few things are happening. There is a big demand shock that lowered oil prices to near 60, and that's unrelated to the OPEC Plus decision. And there is the supply shock from OPEC Plus, and the supply shock contributed about $1.50 to $2 to the decline in oil prices. So how costly is that $1.50 to $2 decline in oil prices? Saudi produces 9 million barrels a day, roughly. So that cost is about $5 billion if it persists over a whole year in lost revenue. What is $5 billion? Is it big? Yes, it is big. But put it in context. Trump is demanding $1 trillion from Saudi Arabia over his 5 years, and $5 billion over his 4-year term, and $5 billion could contribute to this. It is costly, but it's affordable. But one thing is important here. It probably cannot be repeated for the reasons that you've mentioned. Saudi Arabia needs oil prices at near $100 per barrel to balance, to meet its spending. $5 billion and lower oil prices does not help towards that. It might be a one-time gift, but it probably won't be repeated.
Yeah. Well, interesting perspectives. And as we're speaking, of course, keeping a close eye on what happens to the energy complex, because people in the region are very focused on that now. Ziad Dawood, Bloomberg Economics Chief Emerging Markets Economist. Thank you. Okay, some breaking news. India's RBI has cut its interest rate by 25 basis points to 6%. That is in line with what the market had been anticipating. And of course, let's not forget that India themselves are now subject to higher interest rates, tariff rates, now that these reciprocal tariffs have gone into effect. 27% is the rate that's going to be applied on Indian goods. And just to give you a little bit of commentary that's coming through, RBI is saying inflation is below target, but growth is still on the recovery path. MPC noted India inflation currently still below target, which gives them the impetus, of course, to cut interest rates. It was a unanimous decision to cut the repo rate again by 25 basis points to 6%. And the stance signals intended direction of policy rates. So there you have it. Dovishness out of the RBI with that monetary policy cut, changing the stance to accommodative. Now, one point we noticed this morning as well, as Asia prepared for the tariffs to come into effect. This is another chart. I feel like every time I come on the show, I'm talking about the superlatives, but look at this one. The Bloomberg Asia Dollar Index fell to a record low this morning. Record low, all-time low for these Asian currencies versus the USD. Joining us now from London is Luis Costa, Head of Emerging Market Strategy at Citi. Luis, what do you make of the market moves this morning? It's a loaded question, but it's risk-off everywhere, and we are seeing liquidation of sorts go through in U.S. Treasuries.
That's right, Jumana. You mentioned superlative. It's a superlative moment for the markets. We are now trading stagflation in the U.S. That's the story. And in potential stagflation regime, what we've got a situation where the 60-40 portfolios, the risk parity portfolios, they just don't trade well, which, I mean, you mentioned the move we had in treasuries. That could be part of it, that could be related to some cash provisions. But, I mean, we know that the story is developing in a background where we are constantly revising short and medium-term inflation expectations in the U.S. And in the meantime, here we are taking growth off the system, not only from the U.S. You mentioned the tariff effects in so many EM economies, especially the so-called supply chain Asia, the factory Asia. So it's going to be difficult for the coming weeks and months, but because we will continue to digest this information, and if you put it all together, is stagflationary. So very difficult to imagine that some of the bonds will perform well, especially given the price action we're getting in the core, and FX will respond to it. And in the meantime, equities will continue to reprice lower. So it's a very complicated market, and I think that investors will be extremely tempted to take more resources into cash.
Let me ask you, Luis, do you think enough of the bad news has been priced in to, let's specifically focus on the Asia region right now, Southeast Asian economies? The reciprocal tariffs have now been put in place. So they're there, right? So anything that could happen from here onwards, if, let's say, Vietnam manages to negotiate a deal for themselves or Japan manages to negotiate a deal for themselves, that will be a marginal positive to the markets. So you could say that potentially we're at peak bearishness right now. Do you follow my logic?
I do, and I think that's, it's very difficult to call the zenith here of this bearishness still, Jumana. I think that it might take weeks and months for us to get let's say a critical mass in terms of potential deals with the U.S. We know that some countries like Vietnam, Japan, they are already engaging with the U.S. government, and according to President Trump, dozens of countries already call him asking for trade negotiations. So, but that takes time, and we know that the U.S. administration is asking for very important changes as well in terms of non-tariff barriers, and it will take time for these countries basically to reach a common ground here with U.S. administration. I do believe that as we go into the coming months, we are probably going to see some softening of this very hard price action we are getting now, but it's very difficult to say that just now and this week right after Liberation Day is the peak bearishness.
Yeah. Okay. Luis, I know that you were in South Africa recently on an investor trip, or your team were, and we spent a lot of time on this show talking about the dynamics in South Africa. Of course, they've been hit with tariffs, but at the same time, there's some political sensitivities right now between U.S. and South Africa, not to mention question marks about the future of the coalition there. What is your view on South African assets and where we go from here?
The view that is for the first time we are trading, many generations of traders out there, they are trading coalition politics for the first time in South Africa, and we are seeing implications of that. We do believe that this the back end of the curve will be still under the influence of all the headlines, and they are tough headlines. We know that, the conversations between the DA and the NAC, they have become more difficult. We are still looking into eventually another form of government of national unit. It's going to be very interesting to see how investors will take this potential new form of government national unit. But most importantly, going back to bilateral relationship, it's a question mark in terms of how friendly the relationship will be with the U.S. on the geopolitical side. So this is all coming to fruition now, which in a market that has been squeezed into local bonds in South Africa, high yielding, very steep curves. So markets, up until end of last year, markets were really enjoying this type of positions. And now it's a time to step back a little bit.
Okay, final question. In your notes, you say that LATAM is a relative winner. It's surprising because for so much of the campaign, Trump was talking about Mexico, 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 but actually Mexico made it out all right compared to the rest of the world here.
That's right, and let's not forget that as we are downgrading, that is a positive. I know it's very cruel, but it's a positive development for bond investors, especially local bond investors in LATAM, because the downside bias in U.S. growth is definitely pushing expectations of growth in many satellite countries in LATAM down as well. Mexico is another one. It could be the case of Brazil with very high real rates. So we continue to believe some interest to play more LATAM compared to other parts of EM now, and I think this trend will probably continue in the medium term.
Yeah. So interesting to get your perspectives. Always good. Citi's head of emerging market strategy, Luis Costa. And thank you for getting up early for us, Luis. We appreciate it. All right, coming up, Kenya's central bank surprises with a steep rate cut amid elevated risks from the Trump tariffs. Details next. This is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Kenya's central bank has slashed its interest rate by 75 basis points, a deeper than expected easing amid heightened geopolitical risks from President Trump's tariffs. Bloomberg's Andiro Ganga joins us now. Well, central banks around the world obviously taking note of the growth impact from tariffs, Kenya being one of them. They cut more than expected, Andiro.
Absolutely. And Juman, I hear you while you're saying that tariffs are now the focal point, but the central bank has other priorities. They say the goal here is to ensure that credit is flowing to the private sector and in turn stimulate growth in the economy. Leading to this cut, they've now cut rates by 4 times, and this 75 basis points cut brings rates to the lowest level they have ever been at 10% since May 2023. But the governor, Kamau Thuge, is still frustrated that the credit demand in the private sector is not there, and this is affecting economic growth in the country. And a couple of factors can explain this. One, pending bills, government arrears are dating back to 10 years ago. Then you have anti-government protests that made businesses a little bit cautious in terms of spending and expanding. And there have also been a series of taxes every single year, rather. And what this has done is it has shrunk payslips and reduced purchasing power for the people, and also reduced capex and opex for businesses. And so while tariffs might be a problem in the long term, in the short term, Kenya is focusing on its internal issues. External factors are not going to support growth. They're scaling back on aid, and also these tariffs are going to affect revenue in this country. So the government would rather align its ducks so that locally the economy can support itself.
Yeah, and right as you're speaking, we have this list up of these reciprocal tariffs applied on specific African nations. They're high, and they're going to have an impact growth-wise, but also in terms of debt reservicing, because many of these countries' bonds have been dropping quite a lot, and that's not taking into consideration also the duration move that we're seeing this morning as well. So Bloomberg's Andiro Ganga in Kigali, Rwanda, thank you for bringing us the latest out of Kenya with that surprisingly big central bank cut as well. And we continue to watch this market sell-off in reaction to Trump's tariffs. Take a look at futures right now. We've got all of them leaning to the red. We've got S&P futures down 2%, European markets down almost 4% now, Asia Pacific down 2% as well. So a really negative session in sight when the markets open up in a couple of hours' time. And this in response to the fact that those higher reciprocal tariffs have now officially gone into effect for those 50 countries, the 50 quote-unquote worst offenders. And this is the market reaction, not just there, of course, but keeping a close eye on the reaction in U.S. Treasuries, too, with 10-year up 20 basis points. More in just a moment on what's been happening there. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Checking the market reaction to Trump's tariffs. Take a look at fixed income. 5-year yields up 13 basis points. 10s up almost 17, while 18 basis points. 30-year yields up 20 basis points. All of this has happened in the last couple of hours. Really speaks to a capitulation / liquidation that's going on in this market. Let's bring in Bloomberg's Valerie Teitel, our markets wizard. Val, I know that you've been looking at these moves very closely as well. At what point does this become so disruptive that the Fed may have to step in?
Well, look, Jumana, in the last few sessions, we even heard from Scott Bessent saying that the market functioning has been all right up and around this liquidity. But the overnight price action and what happened into the close with the Treasury market really points to the fact we could be headed towards a market dysfunction in the world's most liquid market, and that is U.S. Treasuries. Take a look at the 30-year yield, Jumana. Just on the week, in the last 3 days, it's risen 50 basis points. We've seen swap spreads also widen out. This is a signal not of a repricing in yield, but that there is a scramble out there to raise cash from end users. I would note, Jumana, is that there are other ways that we can look at funding markets, for example, to see other ways of stress. And the Treasury market is really a standout in terms of showing this stress. We're not seeing it in cross-currency basis. We're not necessarily seeing an overnight repo, but we are just seeing it in the flat-out Treasury market, really posing some questions about the health of balance sheets out there in order to take down this paper. Remember, if you're a corporate and you are under some financial stress, you are selling your Treasuries in order to hold cash on your balance sheet, but you need someone to buy those Treasuries. And I think what the market is telling us today, there's not a lot of balance sheet out there to absorb it.
And Val, the move in the dollar also interesting as well. Despite all the risk off, it continues to drop today.
Exactly. This is really not a price action we normally see. Normally in a broad risk-off scenario, we see Treasuries rally. We see the dollar strengthen. We're not seeing that kind of correlation today. This is posing a lot of questions over what really is going on out there. I want to note, Jumana, is that during the blow-up of March 2020, even during 2008, we had significant Treasury market dysfunction. And both of those times, the dollar really strengthened off the back of that. So keep an eye on the dollar. Maybe our next barometer for further dollar funding stress in the market. We do have another catalyst on the board today, and that is the 10-year Treasury auction later today, $38 billion being issued.
Yep. Val, thank you so much for bringing us the latest and explaining some of the moves to us this morning. Valerie Teitel in London. Well, we are ending our show, but of course, the market's still heavily responding to the reciprocal tariffs announcement. Daybreak Europe comes up next.